What's going on, everyone? I'm John at SendBird. Today on this video, we'll chat a little bit about how to raise a seed round for your startup. Just to provide a little bit of context, I personally raised a handful of seed rounds in the past across multiple companies. Also with SendBird, we've collectively raised over $120 million to date from couple of seed and then Series A and then to Series B. Which ended up being $102 million led by Iconic Capital and Tiger Global Management. And I've also personally invested in probably about a couple dozen startups to date across seed stage, pre-seed, Series A, and then have been helping out other founders when they're kind of fundraising. So today we'll talk about 5 different sections of seed financing. First, just defining what seed round is. It's one of the, I guess, very loosely defined terminologies of seed round. I think these days they're pre-seed, seed, pre-Series A. It's all kind of mixed up together. But just make it very simple. Think about seed round, Series A, Series B, and whatever that follows until your IPO or big acquisition. So first, what is a seed round? Generally, it's if you have a proven team, then you can potentially raise a seed round with just your idea or a very early prototype. But if you're like first-time founder or haven't really proven a great success in the past, then you probably need some form of a prototype, working prototype, or have created an MVP, minimum viable product, and is starting to get that early to minimal level of traction. And early traction here typically means like pre-product market fit, so you don't have to be like growing, tripling, quadrupling every month or every year, but it's like at least some level of enthusiasm among your innovators and early adopters from your customer or end users, depending on whether you're consumer or enterprise / B2B software. SendBird is B2B, so I'll probably use a lot of B2B analogy and examples on this following videos. So just to put a little bit of context. So seed round basically could be you're pitching your dreams, hopes, a little bit of early traction, and then really getting the investors to believe in your vision and what this potential could be, and also what the upside could potentially be like. Second part, just mechanics of the seed round, right? So historically, there have been multiple different ways to raise a seed round. Could be convertible note, could be a price round, could be common or whatnot. But these days, what companies end up using, at least in the Silicon Valley, is what people call SAFE. SAFE is a standardized seed round financing mechanism that have been created by Y Combinator. So if you go to ycombinator.com and go to resources, there are a ton of helpful articles and resources to learn about just building a company. But if you go all the way to the bottom, there's a documents section, and then you can find helpful templates there, including the SAFE. And just a couple terminology to know about SAFE when you're first doing your seed round with SAFE is that you have to obviously have the amount of investment check size from the investor, but what you as a company need to set is the valuation cap. So valuation cap is basically, when the SAFE converts to an actual share, a preferred share, what is the maximum valuation is going to be. And the valuation at seed round can range anywhere from a few $1 million to $10-20 million, and sometimes even beyond if you are like a proven and repeat founder. But in most cases, it'd be kind of like in the few millions ranges is more typical than those kind of 8-figure valuation. And then one thing to note about valuation in general is that you don't want to be too greedy in your early days because your company is still not proven. You haven't reached the product market fit. You don't know how fast your company is going to grow. You might have to pivot. So if you go for a high valuation and then end up not getting to Series A, then you might have to raise multiple seed rounds. And then the future investors are not going to be happy with increasing valuation, and also because of your existing investors, you can't really lower your valuation either. So there's going to be some pressure. Of course, you can, but it's going to hurt your reputation and the credibility of your company. So you want to have those like steps kind of well thought out in terms of what are specific milestones you want to hit during seed round, and what is kind of your simulated valuation that's going to happen, best case scenario, but also worst case scenario, so that you're not shooting yourself in the foot by being too greedy with the valuation. In terms, again, going back to mechanics, when you're raising a seed round, investors tend to come in kind of three different flavors. Well, there's family and friends, but professional investors, right? There's angels, or so-called high net worth individuals. These are people who could be ex-executives or startup founders, or someone who just happen to have a lot of money. They can probably write checks when you're in the low thousands of dollars to kind of like low hundreds of thousands of dollars. So it could be $5,000 check or $200,000 check. It's kind of that range. And then there are seed funds. These are professional funds, not individuals, but funds that actually focus on the seed stage. So they tend to write, kind of low to mid six-figure ranges. Could be $100,000 to maybe $500,000. And there are also VCs who kind of typically invest in Series A and Series B, but sometimes they would actually do Series Seed because they want to learn about the market and kind of bet on some of the proven founders, where they want to get the early access to the information. And when these companies are ready to raise Series A, they can actually go in more aggressively and try to preempt around as well. So VCs can write six-figure check to maybe a couple million if you're doing a more of a bigger seed round. So that's kind of like three different flavors when it comes to investors during the seed stage. And in terms of the target equity, how much dilution you're going to have during the seed round, well, Series A tend to be a little bit more specific because Series A investors tend to have a specific target ownership. But seed, because you're dealing with multiple different investors who write a couple $1,000 check to hundreds of $1,000s, and if you're raising, let's say $2 to $3 million in seed round, you may end up having 5, 10, 20 investors who join your seed round. So they're not going to have a lot of say or interest in the ownership percentage. Some may, but typically they could be having a percent or a couple of percentages in terms of their ownership. So the company gets to kind of dictate the terms or at least a target equity a little bit more. So you are kind of setting the guidelines around how much dilution you want to have. So you should actually be more focusing on like what is the next milestones you need to hit to get to Series A, and how much capital will you need for your specific business, how many headcounts, how many months of runway do you need to have to get to the next level, and kind of plan it from there. And always kind of assume that you're going to need more time, more headcount to actually get to this level. So you want to probably add a little buffer there as well. But again, it's a right you have to get the right balance of how much dollars you need to raise, what's the valuation. But if things don't work out, maybe you need to raise an additional round. So you don't want to be too greedy. So you have to find the right balance there. Because again, getting to product market fit, there's not a lot of like silver bullets there. So you'll have to do a lot of experiments, and then that's kind of the thing that's difficult about C stage, is that you're not really there yet. And also one thing to note, if you're a first-time founder, have never raised before, is a notion of pre-money and post-money. Basically, pre-money, let's say you have a pre-money of $8 million, you raise $2 million. On top of that, then your pre-money becomes $8 million, and then you raise $2 million. So post-money would equal $10 million, because 8 million with 2 million on top was equal 10. So this kind of pre-money and post-money, when people talk about these kind of terms, you want to know what those terminologies mean. Third is what you're pitching a seed round, right? Some people come with a 5-year financial forecast to your business, which actually doesn't make sense if you're a seed stage. Some investors may ask for it. They're not, either they don't know what they're asking, or they're just trying to understand your assumptions. But at this point, what you're really pitching is your narrative and your team. That's pretty much what you can do. If you're raising a Series A, then you probably have certain level of traction, metrics to show there's repeatability and scalability, all of those good stuff. But if you're raising a seed round, what you're really pitching is your narrative and the team. And the narrative here means that it's not some beautiful story. You woke up one day, you fell in love with this idea, this is your biggest calling ever. It's not that. It's that there's a big enough market / problem that is happening now. And why is it happening now? You need to be able to answer these questions really clearly. Whether there are some changes in the market that created a new opening, or there's like a new trend. Let's say remote working is becoming a new trend, and obviously there's going to be softwares and like companies and services that's going to help those things. Think of like pickaxe selling pickaxes and jeans during the gold rush. So gold rush could be a trend, or either an old industry has gone stale. There's a new technology that's going to kind of create a new leverage or productivity increase to the old industry. These are also kind of good stories too. So there has to be a big enough market / problem, or that market still could be small today, but in your wildest imagination, there is kind of a world where this small kind of niche can ultimately become big, again, because of that macro trend. Second, you found a compelling and a differentiated solution to address this problem. So there's a market, and you found this kind of like a really interesting idea or really interesting product that can solve this problem really well. And then you have to be able to convince the investor that you are the right team to actually build this product and make sure that this product, your solution, becomes the market leader. So kind of making that alignment is what is your kind of the narrative that you want to pitch during Series Seed. And unless you already have like a meaningful traction, you need to really focus on the size of the opportunity. And again, why is your team the best one to solve this? And ultimately, not just your team, but you as a founder, and probably you're the CEO or CTO of this company, then you have to sell yourself that you are trustworthy and have the determination, obsession, and tenacity to really solve this problem well. So ultimately, you are pitching yourself, and the investors are investing in you. So ideally, if you have some form of traction, whether it be ARR, revenue, customers, LOI, shipped product, customer feedback, online presence, NPS score, whatever that is, obviously more the better if you can prove that there's enough data point. But if you don't have that, at least you need to be able to convince with your narrative and yourself and your team that this is actually a really, really interesting and big enough opportunity. So that's kind of what to pitch during your seed round. Fourth, this is actually a really important piece, is running a tight process. Especially first-time founders, because raising capital goes kind of against your instincts. You probably want to meet one person at a time, and then you get their commitment, and you get to an agreement, you raise money. But investors, when raising money, you want to run these processes in parallel, not in serial. You don't want to go talk to one investor, they say no, then you go to the next investor. You want to talk to all the investors at the same time within a week, maybe 10, 20, 30 investors in a single week, and then have conversations and be able to close a seed round within, let's say, a month. A month would be great, 2 months maybe, but you want to run a really, really tight process. It's like juggling a ball, but not just 2 balls, but you're juggling 10, 20, 30 balls. So there could be a lot of mix-ups, so you have to be able to create a really good cadence of following up, and then making sure you're using software, whether it be something like a CRM software, pipeline management software, or even something simple as Google Sheets or spreadsheet to manage all the investor conversation you're having, what stage they're in, and things like that. So be ready to run a really, really intense type process for at least 1 full month. And there are really only 2 main seasons to raise capital, at least here in Silicon Valley. One is a longer season from January to June. Usually like first week is kind of slow, so maybe second week all the way to mid-June is kind of the longer season. And the second shorter season is between September and November. And remember, when when people goes near Thanksgiving, people start going away on a family trip or vacation. So investors tend to become really slower to respond, or actually become out of the office in November and December. You can just imagine they're gone. Not everyone, of course, but from your perspective as a founder, your pool has shrunk. Your market has shrunk, literally. And same with July and August. Investors could be traveling around the world and going on a nice vacation in Hawaii. So you don't want to spam investors during those periods. So focus on those 2 main seasons and figure out which season you want to raise. Of course, sometimes you're just running out of money, you have to raise during summer. Well, you want to plan for those things as well. And again, just to really highlight, don't worry too much about the dilution at this point, as long as it's kind of in the normal ranges. Because if you can't get to the next level, whether it be Series A or getting to profitability, it doesn't matter at all. What dilution you have doesn't actually matter at all at this stage, because you haven't reached the product market fit. But of course, you don't want to be, you don't want to be too diluted, and you have like no upside when your company raised Series A and Series B, because some misinformed founders / investors may do crazy things like 50% dilution as seed. I've seen that play before. Don't ever do it, but as long as it's in a reasonable range of, let's say, 5%, 10%, 15, 20%, those are kind of okay ranges. It really depends on your appetite and your plans, but again, don't worry about 1% more, 2% more or less at this stage, because it really doesn't matter that much at this stage. Unless your intention is to bootstrap and completely own your company. There are companies that have done that play and have become also very successful. But if your plan is to grow quickly, raise capital, grow quicker, and then go for the big IPO or big acquisition, then at seed stage, don't worry, don't be too concerned about an extra point here and there. It doesn't really matter. Focus on increasing the size of the pie rather than the rate of dilution. And also, there are other factors like fundraising environment too. Like, what are investors? Are investors fearful of your space? For instance, some investors don't like HR technology or marketing and ed tech, or some investors are just not familiar with biotech, right? So talk to right investors who've made a success in your similar category before, or at least they're really interested in learning more and getting into your space. And then, is your space hyper competitive? Are there too much noise? It would actually be harder to convey that you are really the compelling and differentiated solution to the market. Even if it could be a really, really massive market, if there's 1,000 competitors that investors already know of, then they might, just think and say you're not the one, and they might want to see that you actually get to that point where you build that product market fit and you have built this repeatable, scalable, differentiated solution. So they might be a little bit more cautious there. And then also, are there general awareness of your space and your business model if it's something new? For instance, when I think some of the APIs company came out to the market in the early days, they had a really hard time raising their initial seed and Series A, because first investors didn't really understand how API economy worked. And usually back then, a lot of this software, SaaS software, was being sold to, let's say, marketers and sales. And now the APIs, again, was selling to developers, but wasn't typical IT CIOs. These are engineers, bottom up, selling motion. They weren't quite used to this idea. So it took some time to educate the market. So if your idea or product is something that's really new and there's lack of awareness, and there's going to be some education cost equal time that's going to go in. So the fundraising environment also kind of impacts your seed round. And with Series A, you actually want to create a sophisticated, thoughtful target list of investors and their partners and the firms, and look into their portfolios. But that seed stage is gonna look a lot more random, because there are a lot of individuals, rich individuals or angels who just want to help you out. So, but you still want to manage those lists and again run a tight process. And how you kind of build up the list is, especially if you're a first-time founder, you don't really know the investors yet. Cold mailing rarely works. So the only real two source that actually works really well with high signal-to-noise ratio is intros from the founders that are in a kind of a similar category of business. Let's say if you're in B2B, then you probably want other founders in B2B to refer you to an investor, right? Or if you have met investors in the past who've invested in similar, like B2B, then you probably want to reach out to them. Or investors who backed you in the past at your previous startup, that could also be a good list. So basically, investors who backed you in the past, or get introduction from founders who are kind of doing something similar to yours, not in terms of the business itself, but the category of the business. And again, meet it all once in a short period of time. Target rolling close. The good thing about seed round is that if you're using something like Save, unlike price round where everyone has to line up, sign on the same paper, with seed, especially with Save, each individual or each investors get separate papers, so that you can do a rolling close. You can close, $5,000 check, $15,000 check, $100,000 check, and continue to collect your checks, and then fill up your round. So it's easier. So don't wait until everyone lines up. Just if you think you found the right investors, close them, move on, go to next investors, and run a really tight process. So you're not forever raising. You're not raising for 6 months. You're raising for a month or maybe 2 to 3 months, and then you close and get a focus on your business and growing your business. So, and when you're kind of communicating your target round size, my general recommendation is to have 2 different target goals for the raise: a minimal raise and an ideal kind of a larger raise. Let's say you want to raise $3 million, but what you absolutely need, let's say, is $2 million. Then the $3 million would give you that extra, leg room per se. So then what I would do initially is to communicate that you're raising $2 million. Let's say somebody came with, maybe you've already kind of have a $1 million committed. Then you can go back to the investor and say, hey, 50% of the round has been committed. You have $1 million left. So you're showing a tighter kind of a range with a faster progress. So if somebody commits, again, a $100,000 check, you can really show the progress of your round pretty quickly. But if you say you're raising $3 million and you only have $1 million committed, then your round is not half full, it's only 33% full. Then it feels like there's a lot more work to be done. So it actually creates unnecessary fear and concern to the investor. So have kind of 2 different target goals for the raise. Start with the smaller one, and if they fill up, you can simply say, hey, we are oversubscribed, so we're going to extend the round to an extra $1 million. So if you know anyone in your space, please make recommendations so that you can kind of use your existing investors who you already closed, and then use their network, get help from them to bring in more great investors to your cap table, so that you can get more help, and then also be able to raise a bigger round to your ideal goal. So that'd be kind of a tactical advice. And again, run away from bad reputation, investors with bad reputation. Always do due diligence if possible. If you're part of an accelerator or some form of a startup community, then you can ask around your network in confidence. But if not, at least look up online on AngelList, Crunchbase, see if there's any company you recognize, reach out to them and get their advice. Again, investors referring investors is always also a good sign. So the investors that you trust and respect, if they refer you to someone else, it's probably a good investor that you can kind of rely on. So that's general recommendation. And then cold emailing rarely works. They do, but probably not the best use of your time. So if you can, go with your warm intros. And again, remember at this stage, they are literally investing in you. So be presentable, show energy, conviction, and again, be great with follow-ups and response times. Investors get excited too. They invest out of excitement, especially during this time. They invest during seed round, and angel investors especially invest because of a million different reasons. Some just want to help someone like you. They can resonate with you because they've been in your shoes before, or they just have a lot of money laying around in their family, so they want to diversify their asset class and things like that. So be responsive, close fast, be great with follow-ups, so that they can trust in you more. And lastly, closing, you have to really learn the protocols. Look at them online. There are great articles out there written by people like Justin Kahn. And then just learn the protocols, like how to communicate timelines, be transparent and honest. Don't lie about someone that have not committed to your investing in you. If they show interest, they're not committed. So there are specific protocols like handshake protocol, and you have to be direct and very clear about asking what you need and whether they have fully committed or not. Unless they fully really committed, whether it be verbally or written form, they're not committed, because investors also know other investors. They can easily pick up the phone and call or text and say, oh, I have not committed, then your entire round could just collapse. So make sure that you're being truthful and honest. Don't stretch or bend your reality too much. So learn the protocols and specific terminology that is related to fundraising. And again, at seed stage, using safes, you don't need everyone to sign at once. So you can just sign and close one by one and move on. And kind of like tactical advice, and I see a lot of founders don't do this well unless they're part of some form of an accelerator, is making sure all parts of the process as frictionless as possible for the investor. Have your blurb ready, have a short introductory deck ready if possible. If you have any good metrics, have a bullet point of your impressive metrics. Send all the documentation to sign using DocuSign or HelloSign so that they don't have to download a PDF, print it out, sign and scan it, things like that. Make it as frictionless as possible, and always attach the wire instructions. Have it ready so that when they sign, you're sending wire instructions automatically. So make it really, really dead easy for them to move to the next step and close. And as soon as you've closed the round, of course, you want to go immediately back to focusing on building your company, but you want to start communicating regularly to your seed investor, at least on a monthly basis. Send investor updates. Don't sugarcoat the bad news. Say in a very dry manner when it comes to bad news or good news, so that you're managing their expectations, but you're also building the trust and reputation from your investors. And they can really become really helpful during your Series A, providing references for your company to the next investors, and also helpful with advice and introductions, because the world is a really, really tightly knit, small network, small world. So investors know a lot of people through some random occasions, and you never know what's gonna come from those networks. So always keep yourself open-minded. Again, communicate regularly with great process hygiene, and then focus on getting to the next step. So that was kind of a long rambling on how to raise a seed round. And wish you best of luck on your fundraising, and then go out and build a great company. Thanks.